Hello, I'm Daniel, and I'm reporting live here from Gothenburg, Sweden. I've been a long-term Alibaba shareholder, and today we're going to go through the Q3 2025 earnings report. This is not financial advice. I'm just sharing my own journey and my own perspective on my own stock position here on YouTube. So Alibaba is a third of my stock holdings and very, very big position, and I still believe that there's growth to be expected in the company. So, holistically, they have been growing for 15% on the revenue growth side, excluding the SunArt and InTime revenues. SunArt is a Chinese equivalent to Walmart, you could say. And these businesses, while not being so profitable or not profitable at all, actually, not at the moment at least, they do contribute a lot to the revenue since it's very big businesses, a lot of stores, but they have deemed themselves being unsuccessful in competing in that area. And they're refocusing all their engagement to the e-commerce side and the AI side, which they have been more successful in the past. And it's very nice to see that they're refocusing their energy into the core businesses that we have seen historically being very successful for them. So I believe it being a reasonable thing to actually sell in to these earnings, which is they have been growing 15% excluding these non-core businesses, which is a very, very healthy growth. It's also nice to see that the AI is growing healthily. It seems like they're taking market in the quick commerce side. Quick commerce right now in China is a very fierce market, and they're putting a lot of money into securing a proper market share in that growing business. And it seems like they have been doing it successfully, like they're showing really healthy growth in the quick commerce side. And while I'm not fully aware of all the competition's numbers, it seems like Alibaba is taking a proper position inside the quick commerce, which is really nice to see. And it's also nice to see that the China e-commerce is growing as communicated. The China e-commerce is the one business inside of Alibaba where they make the most money at the moment. Everyone talks about the cloud segment and the AI segment, but the China e-commerce is the segment that has been a drag on the stock since 2021, 2022, because they have seen their growth been shattered, and now they have come back, and we still see a pretty healthy growth pace there. They are guiding mid to single digits, and in my valuation thesis I have put in a growth number of 8%, and it seems like they are hitting those numbers. So this last quarter they have been growing for 8%, which is really nice to see. And the other growth, which in turns make it so they have been growing for 15% in the China e-commerce segment, is coming from the quick commerce side. So that is very nice to see. That is not something that I have widely been calculating on. I have calculated on the China e-commerce being able to grow back to 8% at least, and they are doing that, and the quick commerce is coming on top of that. So really nice to see. So we're going to look at the numbers from all their 4 segments that they're reporting on. It's very important as an investor to understand as much as you can of the business. And in order for you to do that, it's really nice if you're able to understand what they're reporting on and what type of numbers are we looking at. We're going to look at these 4 segments one by one. We're going to start out with the China e-commerce side, which is the segment that they're earning the most profits from at the moment. And these are the numbers that I put on into my valuations. So as you can see here earlier, they've been growing 30%, 40%, and then the growth rate come crashing down 2022, 2%, 1%, 6% minus. And for 2025, they have turned this around. So for 2025, we are expecting a yearly growth rate of 4% from the other year. And this quarter alone, they have been reporting an 8% growth on the core commerce, the core China e-commerce, and they have been reported additional growth from the quick commerce side. So how did the numbers look? So you can see here, they have been growing 16%, which is very, very good, but the EBITDA margin here is only 14%. On a long time horizon, we do expect this margin to be very high, at around 30%, because this is a very high margin business for them. The margins has come down, but we do expect the margins from this business to be in the high 30s. So as we can see here, their EBITDA margin is only 14%. They're talking about the fact that this only 14% is due to the fact of this quick commerce, really competitive business. So I deem that to be a reasonable explanation for the margins to be as low as they are, because they're growing a lot on the quick commerce side. And this growth for 16% is huge. So excluding the quick commerce, they're growing 8%. So the other 8% come from the quick commerce side, which is a big number since they're coming off from a very big number before. This is not a small business. The China e-commerce group side of the business is huge. It's very big. So that they're able to grow the total business by 16% is huge. It's very, very big. It's nice to see. As we say, the margins is not that good, but I deem it to be a reasonable explanation for this high growth. That is a price that you have to pay. In the future, we do expect higher margins from this business overall. Next section is the international digital commerce. These are the AliExpress, the international business side. Usually they have been growing this business for a very, very high percentage here. 32%, 20%, 20%, 29%. This quarter, they came in at a 10% growth, but they have been communicated in the past that they are trying to make this business profitable this quarter, and they have been successful in doing so. It is a break-even margin, but it's still break-even, so it's not a losing business. They earned $23 million. On an EBITDA margin side of it, it's only, it's less than 1% at least. That is why the EBITDA margin here ends up at 0%. So this business is not like the biggest side of their business. It's a pretty small business. In my valuation thesis, I have expected higher growth rates from this business, but the future will tell. And it's not the most important side of the business. The most important businesses in Alibaba are the China e-commerce and the cloud segment. So those are the most important parts of the business right now. When you read the news, they're talking about this segment growing good when they grow 10%, which it's not good. The growth for this segment has usually been around 20-30%. So a 10% growth is actually very bad for this segment. But they have been turning it profitable, which is nice. And it's not the most important thing in their business. So due to that being a thing, it not being that important, I don't deem it to be that important that it's only growing for 10%. So the next segment, the cloud intelligence group. It's a very, very important segment where the AI is and their cloud unit is. So in my evaluation here, I've only counted on 25% growth on this business, and in the future, it being able to earn 30% margins. So how did they perform? They performed a 34% growth, which is very good. And they've had their, 9th or 10th quarter where they've shown triple-digit growth on the AI segment, which is over 100% growth. So that is very, very nice to see. They are earning money here on this business right now. So that is not something that I've counted on. I have counted it on being able to earn money in 2026. So they're earning money on this segment right now, which is very, very nice to see. I do expect them pumping down a lot of money down into this segment for the upcoming future, because they're talking about in their earnings calls that they're not able to meet the demand. So they're going to put a lot of capital expenditure down here, building data centers, creating stuff. So I do expect this EBITDA margin to be minus in the future. It's not that important. The most important thing is they're showing really good progress inside of this unit. But it's really nice to see that they're earning money here. But I do expect it to not be a profitable segment in the upcoming near future, especially since they have this very, very, very quick growing segment of AI inside of a unit. When you have segments growing over 100%, that does not usually make money, because you have to really double down on the resources in order for you to meet the demand, or else you will end up not gaining that growth. It's very important to get as much growth as you can, and you have to have the resources to take that growth. And we have the all other segment, which is their retail place, their logistics play here, the Kainao, and other things. And all other segment, they're showing a minus $475 million loss here, minus 5% EBITDA margin. So this is not good, but like the $475 million it's not like a huge number inside of their profits. They're making, 28 billion net profits this year. $500 million is not that big of a number inside of that, but it's still a loss. And they're not growing this business at the moment due to the fact that they have sold off the SunArt and InTime businesses. What are we looking for? As we said, the AI is growing healthily. They seem to be taking market in the quick commerce. And it's good to see the China e-commerce growing as communicated in the core side, the 8%. That's really nice to see. And what do I see as short-term catalysts? I see their TPUs being a potential big short-term catalyst. The big thing that we're seeing here with Google now being able to sell 1 million of their TPUs to Anthropic, and their Gemini 3 model only being trained at their own TPUs is really good thing to see, because Alibaba could potentially be a big player with TPUs in the Asian markets. Huawei is probably better right now suited to take the first portion of this market, but I do expect Alibaba potentially being able to supply TPUs to a big extent. That could be a big short-term catalyst. It's still cheap, I believe, and China will not sleep. No, China will not sleep. They will be restless in the pursuit of making AI that is better than the West's. And Alibaba is a great player to bet on in this, I believe. So valuation-wise, I still think that this sticks. I do believe that Alibaba in 2035 could be a $3.8 trillion business. And if we do believe that, we do believe that the share price would be 1,636 in 10 years' time. And if we would put a rate of return requirement on that, divide it by 4 to get a rate of return requirement of 15%, the fair value right now I deem to be 409, which is over 100% more than we have right now. This is a choppy stock, and a lot of things could happen to the stock that makes it really hammered inside of the markets. But I do believe the worst is behind us. We never know these things, but seeing the China e-commerce side growing healthily is very nice. Seeing them being able to put out these Quen models performing is very nice. And seeing their cloud segment growing as much as it has is very nice. Any points you think I missed, or you have any feedback, make sure to drop them down below. Elsewise, you have a great day. Good luck with your positions and everything in your life.